It's January of 2021 and the stock market is roaring to all-time highs.
But the economy is filled with all kinds of uncertainty.
Are we heading towards a market crash? Hi, I'm Sam. This is Chris. Thanks for tuning into our channel where we explore achieving wealth and financial freedom through a three-part strategy. Earn more, spend less, and invest the rest. Today's video, we are going to be discussing a potential market crash in 2021. We're going to be sharing with you our thoughts on what's going on in the market as well as the indicators that we are currently looking at. So let's dive right into it. Chris, do we think there's going to be a market crash in 2021?
Well, we think the market is extremely overvalued, whether you're looking at it from a macro viewpoint or as an investor who is valuing individual companies. But trying to time the market is a fool's errand, and to be honest, I wouldn't trust anybody who's trying to tell you when exactly the market's going to crash.
Why is it so difficult to time the market?
Economist John Maynard Keynes said the markets can stay irrational longer than you can stay solvent. During times of extreme overvaluation or market bubbles, the greed of wanting to participate in every cent of gains takes over for those of us who are in the market, and the fear of missing out takes over for those of us who aren't.
So FOMO is a big driver of the market?
It absolutely is. Unfortunately for those who participate in these extremely overvalued markets, fundamentals and logic do eventually take over and force the market to its intrinsic value. And this is where lots of people lose lots of money. Benjamin Graham, who we often regard as the father of value investing, said, "In the short run, the market is like a voting machine, tallying up which firms are popular and unpopular. But in the long run, the market is like a weighing machine, assessing the substance of a company."
All right, so we told you that we feel like the market is currently overvalued. Why do we feel this way? What are the indicators that we're looking at?
Well, the first is the Wilshire 5000 to the domestic GDP. And this is an indicator that Buffett told us was the best way to judge the price of a market. And he uses it so much that it's nicknamed the Buffett indicator.
The Buffett indicator is a ratio that compares all of the publicly traded companies in the U.S. to the gross domestic product of the U.S. That's a total sum of all the business that takes place in the country. Warren Buffett says that when this ratio is at 0.8 or below, it's a good time to invest in stocks. But if it gets to 1 or higher, we should be wary.
Today, the Buffett indicator just went over 2, which is crazy. That's by far the historical high. And it's probably a pretty good reason why Buffett's Berkshire Hathaway is sitting at $140 billion worth of cash.
So sitting in cash means he is not currently vested in the stock market with that money.
That's right. He's sitting on the sidelines waiting for opportunities. If you want to look at the Buffett indicator yourself, the St. Louis branch of the Federal Reserve tracks this on their website with some other great economic data. You can see me scrolling through it here, and I'll put a link to it in the description below.
All right, so that's one indicator. What else are we looking at?
Well, we always keep a really close eye on the Shiller PE.
The Shiller PE is a cyclically and inflation-adjusted price-to-earnings ratio that looks at a 10-year moving average of earnings on the S&P 500. It's a better judge on valuations than the standard PE ratio because it removes fluctuations contributed to business cycles. It was invented by Robert Shiller, who is an award-winning Yale professor and also a Nobel Prize winner. He talks about it in his book, Irrational Exuberance.
So the Shiller PE gives indications of what you can expect your future returns in the market if you invest today. And usually a fair price market is considered to be somewhere around 15 or 16 on the Shiller PE.
And what is the Shiller PE today?
So the Shiller PE is sitting just above 34.
So more than double.
More than double. And in fact, it's the second highest of all time, second only to the dot-com bubble.
The dot-com bubble happened in the late 1990s when the internet was becoming really prevalent. It was a horrible bubble in which lots of people were putting astronomical valuations on tech companies. And it's a bubble that eventually popped, and a lot of people lost a lot of money. All right, so we've talked about the Buffett indicator, we've talked about the Shiller PE. What else are we looking at?
Well, this is actually a chart we just came across recently, and it's comparing the NASDAQ index to an index of commodities.
Falling second in size only to the New York Stock Exchange is the Nasdaq Stock Exchange. They trade primarily in companies that deal with technology and pharmaceuticals. Commodities are the tangible necessities of life. They include things like wheat, beef, grains, oil, gas, silver, and gold. People don't tend to get excited about commodities. Typically, you'll see commodities go up and down with the economy. And in a situation like the dot-com bubble, what you saw was that commodities and the Nasdaq were growing further and further apart.
Commodities is probably the best judge to us of the real economy. We've never seen as big a divergence between these two indexes as we do today.
All right, so we're talking about the Nasdaq and commodities and how they're growing further and further apart from each other. What's next? What are the possible scenarios of how this situation can resolve itself?
Well, there's a few. If you believe that eventually that these are going to converge back on each other, then there's really one of three possible ways this happens. One, there's a huge stock crash, basically bringing the NASDAQ price back in line with the commodities index. Two, there is massive inflation, which is definitely a possibility with global governments, global central banks printing money and putting that money into fiscal spending, which will take place in infrastructure and things like that. So that should cause commodity prices to lift. Or three, it's a combination of one and two.
So which one do you think it's going to be?
To be honest, I think it's probably going to be three. I think we're going to see a market crash combined with inflation over the last 7 or 8 years of the 2020s.
Okay, so we've just covered three kind of macroeconomic indicators that we're looking at to try to help us judge what's going on in the market, and everything is screaming that it's overvalued.
Right.
What else is telling us that it's overvalued from our position as kind of like little guy or smaller investors?
Yeah, well, we're bottom-up investors, so we use these macro indicators as a guideline or as a hint to what the market is doing. But in reality, what we're doing is we're valuing individual businesses. If you value enough individual businesses, you start to get a good viewpoint of the entire market, or at least a sector or industry of the market. So, we are valuing lots and lots of individual businesses, and what we're finding is that all of these businesses are priced extremely high, much higher than we're willing to pay for them. And we just did a video on valuing Apple stock, which I would, which would be great for anybody to watch. And basically, what our conclusion was that it's 3 times higher than what we're willing to pay for it. And this is not an exception. This is, seems to be more what the rule is among stocks right now.
So we've got it essentially coming from both sides. We're looking at the indicators from a macroeconomic level, and we're looking at the patterns that we're seeing emerge on the individual businesses that we are valuing in order for us to deploy our money.
That's right.
So if we're trying to constantly deploy our money and invest it and make sure that our passive income streams are flowing, we're still looking at businesses during this time. Even though we think that the market is overvalued, we're still looking at businesses. What are we looking for in those businesses?
Well, we're looking at businesses that are priced at a fair value. And even though we say the market as a whole is priced very high, there are businesses that are priced at a fair value. And we are buying those businesses. But in particular to this type of market where there's so much uncertainty with the economy and the pandemic and its long-term lasting impacts on the economy, we're looking for companies that do not have a lot of debt. Unfortunately, the last decade has seen a lot of companies take on a lot of debt because it's been cheap, because of low interest rates. And unfortunately, this debt wasn't used in a way that really increased shareholder value. It was used by stock buybacks at inflated prices, paying dividends, or making bad acquisitions, none of which increased the company's earning potential, which is really what we want them to do with that kind of debt if they are going to take it on. So if the economy doesn't recover as fast as what people are thinking and revenues are negatively impacted, this is going to make it very hard for companies with lots of debt to actually meet those debt obligations. And that could lead to a wave of Chapter 11 bankruptcies. And in Chapter 11 bankruptcies, 9 out of 10 times, shareholders are completely wiped out. So we have to be more fearful than ever of companies with lots and lots of debt.
All right, so we've talked a lot about why we feel that the market is overvalued. We're talking a little bit about what kind of investments we're still looking for in this market. What are some of the other things that we're doing as value investors? Of course, we know that we have a significant chunk of money put aside because we're waiting. But for the other portion of our money that we're not putting aside to wait, what are we doing?
Well, like I said, emotion is driving a lot of what's going on in the markets. And even us, we fall victim to the fear of missing out. So what we're doing, we're big fans of selling put options on stocks that we like. And put options are a great tool that a long-term investor can use to participate in an overvalued market, de-risk their investments, and also to create cash flow, which we all could use a little bit more cash flow.
Put options are a wonderful tool for long-term investors to use. So that's a pretty meaty topic in and of itself. We will do a separate video on this, so stay tuned. In the future, we'll get that out for you guys. All right, one final thought here. There may be some of you out there that are thinking, wait a second, we just had a market crash back in March when COVID first started to really hit the US. It's very unlikely that we will have another crash so soon after what happened in March.
Right. Well, markets don't behave linearly, especially during times of market crashes. So most of us know or have heard about the 1929 market crash, which led to the Great Depression. But what many of us might not know is that the market actually crashed 50%, recovered, and then crashed 80%. So, this happened over a year and a half, 2 years. And when we think about a market crash happening in 2021, when we look back on it 10, 20, 30 years down the line, we'll probably just look at it as one market crash that took 2 years to play out.
Yeah, and when we are thinking about the current situation right now in the US and around the world with what's happening with COVID, back in March, the reason it dropped is because people were afraid, right? They were fearful of what was going on. We didn't know what was happening with the virus. Businesses were closing, restaurants, a lot of people in the service industry lost their jobs. So that was kind of that immediate hit. But now what we're looking at is what's going to happen in the long term. What about those businesses who can't open their doors? What about the high unemployment rates? When people are unemployed, they can't pay their mortgage. When they can't pay their mortgage, their homes get foreclosed upon. And there's lots and lots of trickle-on effects from that kind of situation in the long term. And so what we're thinking about is what's going to be happening with the long-term effects of COVID in our market over the course of the next 1 to 2 years.
Yeah, absolutely.
All right, guys, that's our thoughts on what's going to happen in the stock market in 2021. We hope that you found this video useful. If you did, let us know by liking this video, subscribing to our channel, and as always, we welcome your comments below. Let us know what kind of topics you would like us to do for future videos. Remember, earn more, spend less, and invest the rest, and we'll see you next time. Thanks for watching.
Bye.